Welcome to World Facts Channel, another day, another story. In the wake of the 2008 global financial crisis, central banks around the world embarked on an unprecedented monetary policy experiment. In an effort to stimulate economic growth and prevent deflation, they adopted a range of unconventional measures, including zero or negative interest rates, quantitative easing, and forward guidance. These policies have been controversial and have attracted criticism from some economists and policymakers. Critics argue that they distort markets, create asset bubbles, and ultimately risk triggering hyperinflation. Proponents, on the other hand, argue that they have been necessary to support growth and prevent deflation in the aftermath of the crisis. In this article, we'll take a closer look at the biggest monetary experiment in history, examining the policies implemented by central banks around the world and exploring the potential risks and benefits of these policies. Quantitative easing. One of the most significant tools used by central banks in the aftermath of the financial crisis involves the purchase of large quantities of government bonds or other securities by central banks in order to inject liquidity into the economy. The aim of is to lower long-term interest rates, which should stimulate economic activity by encouraging borrowing and investment. The hope is that increased spending will lead to higher growth and employment, and that inflation will eventually rise to target levels. Has been implemented on a massive scale by central banks around the world. The U.S. Federal Reserve has engaged in 3 rounds of since 2008, buying up trillions of dollars in government bonds and mortgage-backed securities. The European Central Bank has also engaged in purchasing over €2.6 trillion worth of bonds by the end of 2018. Zero and negative interest rates. Another tool used by central banks has been the setting of interest rates at or below zero. This has been done in an effort to encourage borrowing and investment, and to prevent deflation. Negative interest rates are an even more extreme measure, in which banks are effectively charged for holding reserves at the central bank. The idea behind this is to encourage banks to lend to businesses and consumers, rather than holding onto cash. Several central banks around the world have implemented negative interest rates, including the Bank of Japan, the European Central Bank, and the Swiss National Bank. Forward guidance. Central banks have also used forward guidance as a tool to influence market expectations. Forward guidance involves making public statements about the future path of interest rates or other policy measures, in order to guide market expectations and influence behavior. For example, a central bank might indicate that it intends to keep interest rates at their current level for an extended period, in order to encourage borrowing and investment. This can help to reduce uncertainty and promote stability in financial markets. Risks and benefits. The policies implemented by central banks in the wake of the financial crisis have been both praised and criticized. Supporters argue that they have been necessary to prevent a deeper and more prolonged recession, and that they have been successful in boosting growth and employment. Critics, on the other hand, argue that these policies have distorted financial markets, created asset bubbles, and increased the risk of inflation. They also argue that these policies have benefited the wealthy at the expense of the poor, by inflating asset prices and exacerbating income inequality. Another risk associated with these policies is that they may become difficult to unwind. As central banks have accumulated large quantities of government bonds and other securities unwinding these positions could lead to significant market disruptions and volatility. Conclusion. The biggest monetary experiment in history has involved a range of unconventional policies, including zero and negative interest rates, and forward guidance. These policies have been controversial, with supporters and critics arguing about their effectiveness and potential risks.